In this video, I will be talking about goodwill. In the past, companies were required to amortize any recorded goodwill. However, because the subsequent amortization would decrease profits, companies would fudge the numbers during purchase accounting to avoid recognizing any goodwill in the first place. Under current US GAAP, goodwill is no longer amortized, but is instead checked regularly for impairment, and a loss is recognized when impairment exists. When recorded, goodwill must be assigned to a reporting unit and then evaluated for impairment within that reporting unit. Annually, goodwill should be tested for impairment, beginning with the qualitative assessment of how likely it is that impairment exists. This qualitative assessment is referred to as step 0 because it comes before the two-step quantitative test. The quantitative test assesses whether and to what extent impairment exists. Please note that goodwill impairment rules have changed since your book was written. The new standard was effective December 15th, 2019, and we will be using the revised standard in this class. This example is taken from your book, but modified for the new rules. Step 1 of the quantitative test is to compare the book value of the reporting unit with the fair value of the reporting unit. The fair value of the reporting unit is essentially the price we would be willing to pay to buy it all over again. If the book value of the reporting unit is less than the fair value, then there is no impairment. In other words, our accounting records say that the reporting unit is worth less than it is. However, if the opposite is true and the book value is greater than the fair value, now our accounting records say the reporting unit is worth more than it is. In this case, we impair goodwill by whatever amount makes the book value and the fair value equal or eliminates goodwill entirely if the difference is greater than our recorded goodwill. In step 2, well, there is no step 2 anymore. That's the change FASB made to the impairment rules. The problem with the old rules is that step 1 used to tell us only whether there was impairment, but not the amount. Step 2 calculated the amount. Unfortunately, the way this worked meant that it was possible for step 1 to indicate that goodwill was impaired, and for step 2 to indicate that the amount of the impairment was 0. Let's just say I'm pretty glad I don't have to try to explain why that makes sense anymore. Okay, so assuming that the qualitative assessment indicates impairment, let's practice the quantitative test in an example. On January 1st of 2013, Porsche Company acquired the net assets of Saab Company for $450,000 cash. The fair value of Saab's identifiable net assets was $375,000 on this date. Porsche Company decided to measure goodwill impairment using the present value of future cash flows to estimate their fair value of the reporting unit. The information for these subsequent years is as follows. So we have a table here that tells us the present value of future cash flows, the carrying value, which would be our book value, and in this case, that carrying value does not include goodwill, but normally it would. And then we have the fair value of the identifiable assets. So that would be all of the assets and liabilities that were purchased in this acquisition at fair value. For each year, determine the amount of goodwill impairment, if any. So we're going to start out with step 1 of our goodwill impairment test. And what we want to do is we want to compare the book value of the reporting unit to the fair value of the reporting unit. Now, because this example is from when there were 2 steps of this test, we're going to have some extra information. And so we're going to have to try to figure out which information we need and what's actually not relevant. All right, so we're trying to figure out book value of our unit. So first thing we need is the book value of the identifiable assets, which is going to be that $330,000. Because remember, carrying value is the same as book value. And in this case, they also told us that it didn't include goodwill, and that was just because they wanted us to calculate goodwill ourselves. So if we go back up to the question, we see that they tell us we purchased the reporting unit for $450,000, and that on that date, the fair value of the net identifiable assets was $375,000. So from our last example, we know that the difference between these two numbers is our goodwill that would have been recorded on the acquisition date. So we're going to take our $450,000, subtract out $375,000, and that gives us goodwill that must have been recorded of $75,000. If we add these two numbers together, we get a book value of $405,000 for our reporting unit. Now we're going to compare that to our fair value of the reporting unit. So if we were going to buy this entity all over again, what would we be willing to pay for it? And our choices here are the present value of future cash flows or the fair value of the identifiable assets. Now, remember, one of these is going to be the reporting entity as a whole, and one of these is missing something. This one is going to be missing any goodwill, because remember, we were willing to pay for the fair value of the identifiable assets plus any future earnings potential, which we recorded as goodwill. This number over here, this present value of future cash flows, is going to include both. So we're going to use this $400,000 as the estimate of the fair value of the reporting unit. And then we're going to take a difference between book value and fair value. In this case, our book value is greater than our fair value. So that's bad. We don't want our book value to be overvaluing our reporting unit. So we're going to have to record an impairment loss. So we're going to debit impairment loss for $5,000, because that was the change, is that this determination that there is impairment is also the determination of how much impairment. And for an impairment loss, we're going to write down goodwill directly. So we're going to credit goodwill, and now the balance in our goodwill account will be $5,000 less after we make this journal entry. All right, so now we're just going to go one more year into the future. So again, we need to figure out what our book value is. So now our book value of all of our assets and liabilities that aren't goodwill is now $320,000. And goodwill, well, it was $75,000, but we just impaired it. So we need to subtract out that $5,000 of impairment we took last year, which means the current book value of goodwill is only $70,000. You're going to add these two guys together, and that gives us a total book value for our reporting unit of $390,000. Now again, we're going to compare the book value of our reporting unit to the fair value of our reporting unit. If we were going to buy it all over again today, what would we be willing to pay for it? And that's going to be captured in this present value of future cash flows number. So this year it's $400,000 again. And we're going to take our book value and subtract out our fair value. And this time we see that our book value is less than our fair value. And so that's good. We're okay with that. So we're going to leave our goodwill alone. We don't need to take any more impairment. So we have no entry this year. Okay, and then we have one more year. So again, we're going to compare the book value of our reporting unit to the fair value. Our identifiable assets, our net identifiable assets, have a carrying value of $300,000. Goodwill last year was $70,000, and we didn't impair it any further, so it's still $70,000, which means the book value of our reporting unit, when we add these two together, is $370,000. By now, you guys should be on to me. Our fair value of our reporting unit is going to be that present value of future cash flows. And we're going to check to see if that book value is larger than our fair value. And it is, by $20,000. So again, we're going to have to take an impairment loss. And we're going to take our impairment loss in the amount that we calculated here, which is $20,000. So that's effectively going to make our book value equal to our fair value as of the recording of this entry. This concludes our lecture on goodwill. Don't forget to email any questions for our discussion.